Everyone dreams of growing their business. Bigger sales, more customers, more profits. It sounds amazing, right? But here's a shocking truth. Rapid growth can actually destroy your company. That's right, many businesses don't die because they fail to grow. They die because they grow too fast. So today, let's talk about how growth, the thing every entrepreneur wants, can become your company's biggest threat. Let's start with something simple. When your company grows, you need more of everything. More products to sell, more staff, more space, more machines, more marketing. And guess what? All of that costs money. So even though your sales are rising, your expenses and your need for cash are rising even faster. It's like trying to fill a bucket with water while there's a hole at the bottom. Money is flowing out just as fast as it's coming in. And here's what many business owners forget. Sales growth doesn't automatically mean cash growth. You might be selling like crazy, but your money could be tied up in inventory or unpaid invoices. And suddenly, even though you're successful, you're short on cash. Here's the dangerous part. When you run out of cash, you have two choices. 1, borrow more money, or 2, slow down. And that's where many companies make their biggest mistake. They choose to borrow again and again just to keep up with the growth. At first, it seems fine. Banks are happy, customers are happy, sales are booming. But debt starts piling up. Interest payments increase. And one small bump, a delayed payment, a canceled order, can throw everything off balance. It's a financial domino effect. That's why many companies that looked strong on the surface actually collapsed because they couldn't sustain their growth financially. Let's look at what's really happening from a financial point of view. Every company has two main sources of financing: owner's equity, the money that belongs to the owners, and debt, the money borrowed from lenders. If a company doesn't sell new shares, the only way its equity can grow is through retained earnings, the profits it keeps instead of paying out as dividends. So the company's ability to grow depends directly on how much profit it keeps and reinvests. If profits are small, or if the company pays out too much in dividends, its equity grows slowly, and that limits how much new debt it can safely take on. In other words, a company can only grow as fast as its equity grows. Think of your company like a balloon. The air represents your assets, and the balloon itself is your financial structure. You can't blow more air in than the balloon can handle. Otherwise, it bursts. That's exactly what happens when a company grows faster than its finances allow. So, how fast can a company grow safely? That's where the sustainable growth rate comes in. The sustainable growth rate is basically your company's financial speed limit, the fastest you can grow without running out of cash or needing new investment. And it depends on 4 key factors: profitability, how much profit you make from every dollar of sales; efficiency, how effectively you use your assets to generate sales; retention ratio, how much profit you keep versus how much you pay out; and leverage, how much debt you use compared to your own capital. When these 4 stay in balance, your growth is steady and healthy. You're expanding, but you're not overstretching. Now, what if you try to grow faster than your sustainable growth rate? You'll quickly notice the symptoms: cash shortages, rising debt, delays in paying suppliers, stress on employees and management. It feels exciting on the surface. Everything's moving fast. But underneath, your finances are on fire. It's like driving a car with your foot on the gas and the fuel light blinking red. You might be speeding, but you won't get very far. So what's the solution? Should companies stop growing? Of course not. The goal isn't to avoid growth, it's to manage it. If your business is growing faster than it can handle, you have 2 smart options: either improve performance, increase profit margins, manage assets better, or reduce costs, or adjust your financial strategy,
reinvest more earnings, or carefully increase your leverage. But remember, every financial decision changes your sustainable growth rate. That's why knowing your sustainable growth rate helps you plan how fast you can and should grow. So here's the bottom line. Growth is exciting. It's what every entrepreneur dreams of. But it's also expensive and risky if you don't understand your limits. Your sustainable growth rate tells you exactly how fast you can go without breaking your financial engine. Because in business, the companies that survive aren't always the ones that grow the fastest. They're the ones that grow the smartest. So before you chase the next big expansion, ask yourself, can my finances keep up with my ambition? If the answer is yes, full speed ahead. If not, take a step back, strengthen your foundation, and grow in a way that's sustainable. Because remember, in business, more isn't always better. Smarter is.